But let's put the spotlight then on CreditAccess Grameen, find out what the outlook is on net interest margins, asset quality, as well as their quarterly numbers. Mr. Udaya Kumar Hebar is the Managing Director, now joining in. Thank you for taking time out. Let's dive straight into the numbers, because your gross loan portfolio, that's grown nearly 30% on year, but you haven't upped the guidance for FY25 to 28. I think it stands around 20 to 25%, unlike some of the other parameters that you've upped. So what is the outlook on the gross loan portfolio?
Thank you for having me here. So, the guidance what we did for next 4 years, which is reiteration of what we discussed last year in our analyst meeting. So largely we believe that the base where we are, it's the largest MFI, it will be reasonable to grow between 20 to 25, not more than that, because the size always matters. So the majority of the growth also will come from the non-microfinance, where retail, which is a new business what we started last year, that will give higher. Whereas microfinance growth might taper down from a 25 to 24 or 22 or 20 by next 3-4 years. So that is what we anticipate. Whereas the current year growth is quite good, quite pleased actually with the 27% YOY growth. With it's a good proud moment of crossing 25,000 crores AUM in our 25 years of operations. Now, which is quite a pleasing moment for us. Also crossing 5,000 crores of income, revenue, which is again a big benchmark for microfinance company in India as a largest company.
Want to talk about your net interest margins as well, which have come in at around 13.1% or so in Q4. But your guidance for FY25 still remains at 12.8 to 12.9? Or would you say that this guidance was much on the conservative side then, and would you then revise it upwards?
It is actually 13.1 is a kind of little aberration, because we had little extra what we call revenue here. Whatever interest change what we did will have an impact in the future. So therefore, there will be about 10-20 pips of variation. That's why we give a guidance of 12.9 rather than more than 13. So we expect that the NIM will be between 12.7 to 12.9 going forward, because what interest rate what we change in December and January will have an impact for next 2-3 years. So therefore, we believe that it is possible. It will be little lesser than the current numbers.
I want to talk about your PAT as well, because that's also seen a healthy 45% CAGR growth over the last 5 years. Can we expect the same kind of momentum to continue for, say, the next 5 years also, and with an improvement?
So actually, it's the last 3-4 years CAGR growth is based on the low profit during COVID time. So therefore, you could see the higher, but otherwise, the CAGR growth of profit will be around 18 to 22% or 25%. That will be the normal profit, because we had a dip in the profit because of write-offs during 2021, 2022. Therefore, the current CAGR is little high, but the reality is between 18 to 25% CAGR growth of PAT, what we expect in future.
Okay, and you've also hiked your credit cost guidance for FY25 to 28. Can you tell us what exactly is going to lead to this hike? How is it going to impact your overall company's performance?
So it will not impact the company's performance, because it's also priced based on that. So the credit cost is hiking because we provide conservatively we treat NP at 60 days, which actually early resolution. We treat a stage 2 at 15-day DPD, so which also makes a higher provisioning. And also we provide differently in the different districts. Now, for example, a district we feel high risk, we provide higher there. So in that process, the provisioning is higher. We are not anticipating much hike in the credit loss. It's a more of a credit cost, because we want to anticipate and provide higher in high-risk districts. So therefore, if you see our GNPA is 1.18 at 60 days. If you see at 90 days, it's only 0.95%, whereas our provision is 1.95%. So similarly, as we go more and more in the northern states and where the non-core geography, we believe we will start providing a little higher even for standard asset until we understand the market completely better. Therefore, we presume there will be little higher credit cost, and it doesn't mean that we anticipate higher credit loss.
Okay, and your cost of borrowing as well has been quite stable for 3 quarters straight. What is the outlook here?
We believe it will remain stable, and maybe until the regulator changes the price to the reverse side, either Fed or RBI. With the changes, we estimate at least for next 2-3 quarters to stable. After that, probably there is a potential reduction of price. But the reduction of price normally will get passed on to customers. So therefore, there won't be impact on our NIM guidance or profitability guidance because of the price change or our borrowing price changes.
But great to have you on the show. Thank you so much for bringing about that perspective on how the future quarters and the quarter gone by has been like.
Thank you so much.
If you like this video, then like, share and subscribe to ET Now.